Well, we're going to get started now. Good morning and happy Friday. It is the most anticipated day of the week. And not just because the weekend's around the corner, we've got our May jobs report day, and we're just 2 minutes away. I'm Simone Del Rosario. I'm the business correspondent at Straight Arrow News, and I am joined by the lovely editor-in-chief at Central Bank Central, Kathleen Hays. Good morning, Kathleen.
Great to be here. I've been sitting in front of screens on Friday morning just before 8:30 for so many years. It kind of gets almost like in your, I don't know, in your muscles or something. But yeah, it's a big day, and a lot is potentially riding on this jobs number.
So this is what's exciting about what we're doing today is that usually you and I are behind the scenes waiting for this 8:30 drop, and now we're going to do it in front of everyone. So at 8:30 Eastern time, we are going to be frantically refreshing our pages to see when the Bureau of Labor Statistics is going to be dropping that May jobs report. And we're going to be digesting those numbers right in front of our viewers. So it's an exciting day for us. But Kathleen, why specifically do you say that there's so much writing on today, especially?
Fed meets next week. They're trying to figure out if the economy is going to slow down enough to signal a greater chance they'll cut rates this year. The latest message has been, we've got to see a lot more better inflation data that shows the that's getting fixed in the economy. I want to quickly say, though, the payrolls forecast is something like 175,000 or 190,000 if you look at Reuters. Unemployment staying unchanged at 3.9%. Average hourly earnings, that's wages, very important. The forecast is 0.3 versus 0.2, a little bit stronger year over year, 3.9%. That's lower than it was before the pandemic, but it's still pretty high. So those are all going to be watched very, very closely, as you know.
And Kathleen, I just refreshed the Bureau of Labor Statistics page, and we have those new numbers. So I'm going to be breaking that to you and to our viewers at the same time. And that is that this is a big number of jobs added to the upside, 272,000 in May. As Kathleen just said, the expectations were right around 180 to 200,000, depending. And this is obviously a lot higher than that. Unemployment rate changed a little. It went up to 4%. And what makes that significant is that had the unemployment rate stayed below 4% this month, it would have marked the 28th consecutive month at sub 4%, which would have been the longest streak since the 1950s. It didn't hit that mark, so we're tying a stretch of period in the late 70s that we hit. But those are the headline numbers right now. 272,000 jobs added in May, way higher than what was expected, and the unemployment rate at 4%. Kathleen, given these numbers, what do you think this means?
Well, it means that the labor market is as tight or tighter than people thought, potentially. We know these numbers are subject to revision, but at 270,000, that is not any kind of a reassuring signal for the Federal Reserve that they can do anything right now except sit where they are and wait for inflation to continue to come down. So I think that's very, very important. Now, with the unemployment rate going up to 4%, the next thing we'll need to look for is the number of people who did or didn't join the labor force, right? Because what can happen if the economy is getting better, people can say, oh, I'll go out and look for a job again. When you're not looking for a job, you're not counted as part of the labor force. You're not counted in that unemployment rate. If you see that more people enter the labor force, that's part of the establishment survey that's calling people at home to see what they're doing. The payroll survey is an actual survey of companies. Anyway, that's going to be another important number. But at 4%, it's still low. It's definitely going to be a ray of hope, maybe for people who are thinking, gee, maybe the labor market isn't quite as tight. But again, more details will help give us more of a sense of that.
And then let's talk about wages. This is definitely something that the Federal Reserve is looking at to see what kind of pressures there might be on inflation. If people are getting paid more, they're willing to pay higher prices. And the Fed can't really squeeze the economy as much as they would like to bring down that inflation. And what we're seeing right now in May is that the average hourly earnings on the month increased 0.4%. That was above expectations. And that means that over the past 12 months, average hourly earnings have increased by 4.1%. And, it's tough because this is a situation that we've been facing for some time since inflation really took hold of our economy, which is that the good news that, unemployment rate's been 4% or below for so long, that wages are strong. The good news is really the bad news when it comes to the Fed and inflation. Isn't that right?
Well, the thing is that it shows that the labor market is still tight. that if people can get higher wages, it's probably because employers need them. They know they're going to have to pay people a little bit better. And remember, before the pandemic, that number would have been running something around 2.7% year over year. And the pandemic got much higher, up to almost around 5%, 4.5%. So what can the Fed do now except say, well, we'll see wait and see what happens. Well, I shouldn't say no one. Some people say eventually, if inflation doesn't come down faster, and if we do see it starting to level out, maybe start rising again, that's going to be an issue for the Fed. Right now, though, this supports higher for longer, wait and see economics.
Yeah, when you talk to people at the Federal Reserve, do you get a clearer answer than what we hear from Fed Chair Jerome Powell, which is more of that kind of wait and see approach? They seem very data driven. Every single week we get things like the jobs numbers, we get inflation reports, but it seems like they're very beholden to what happens that week or the week before. So when it comes to them meeting next week, right around the same time we're getting new inflation numbers, they're going to be looking at this jobs report and saying, oh, it's still really strong out there and we can't move those interest rates.
Yeah, and that, of course, that sense of the labor market going pretty well. I mean, the jobless claims went up about 9 or 10,000 in the most recent week, but at 229,000 a week, that's in a range that's a sign of a healthy labor market. Now, we know the labor market isn't considered a leading indicator; it's considered a lagging indicator, right? And we have seen retail sales, the consumer maybe not spending quite as much, so that could be one sign that demand is easing. That's what the Fed wants to see because they think that's what will bring down inflation. But again, if I'm Jerome Powell or any other of the 18 other members on the Federal Market Committee, I'm going into that meeting next week. You're right. They're going to get the consumer price index on Wednesday morning, the day in the afternoon, they're going to be giving their decision. But for now, all you can assume is that what Jay Powell has said, need many more months of data. Chris Waller, at the Board of Governors, who's become another major spokesman for the Fed, that this is just more wait and see. And again, maybe if you're Jay Powell, you want to say, hey, look, this is pretty good. Inflation has come down. It's under 3% year over year on different measures, but just under 3%. And the economy is still doing well. So This is a good sense of the soft landing. And of course, if you're in the White House, you're probably very happy to see a healthy labor market.
Yeah, happy to see a healthy labor market. And by these types of metrics, the economy is doing well, but that's not how people are feeling. I looked at a report that was published this year, and it said that the majority of Americans are seeing wage increases beyond inflation increases since the end of 2022. However, it doesn't seem like that is how Americans are feeling about the economy. I mean, these metrics show a very healthy economy. I mean, we're talking about record long stretches in low unemployment rates and just, turning and higher wages. But that's not how people are feeling. What's going on?
Well, for one thing, I think in terms of the labor market, people at the lower end of the scale are not seeing the same magnitude of wage increases. I think that's where you still see more pressure, more competition. And if you are someone who's making $40,000 a year, which is not nothing, you look at the cost that people are paying for so many things compared to, say, 3.5 years ago, a high price level, 20% higher than it was before the pandemic. Look at somebody. Are you trying to buy a house? Think of someone trying to buy a house. That's not the Fed's fault. There's a lot of reasons for that. But I think even more importantly, you look at how a lot of food prices are still going up. And you can say, oh, look, inflation's come down. Well, but it's come down from a pretty high levels. And again, the price level is still very high. Seems to me that that's a lot of what people are saying. And another reason why the economy doesn't feel that good to people. But again, I would stress that depending on where you are in the income strata, right, on the income ladder, if you're closer to the bottom, you're paying a lot more for things than you used to. Your rent's gone up. I know they're rising more slowly. Mortgage rates have gone back up to around 7% roughly for the 30-year fixed. So those are all the kinds of things that people are looking at. I think that keeps them from saying, yes, this is a great economy. And of course, for some people it is. I mean, when you talk to people, when you talk to friends and family and people who say, hey, Simone, I saw you on TV. What do you think about all this? I mean, what do you tell them?
Well, look, I think that, like you said, everybody's experiences are different. And I feel like I am very conscious of the fact that people are feeling differently about the economy than the releases that I cover, right? I see the black and white data tables and it points to a strong economy, but that is not the consensus across the board. And when I talk to my family, the biggest things are the things that you talked about. Just the prices in general, groceries falling 0.2% or something like that over the month. And it's like no one's feeling that because grocery prices are up so much over the past couple of years. And then those people who are trying to either move or buy a new house or buy their first home, like they're just really priced out of the situation. So that's the tough part. I wanted to ask you, because obviously the reason that this jobs report in particular is so important is because how it informs the Fed. And they were hoping to see more softening in the labor market than what we are seeing today. Again, 272,000 jobs added, way above the expectations by almost 100,000. So with that in mind, we're talking about rates. People think about their mortgage rates. They think about the Fed's rate, which kind of helps ripple down into everybody else. When can people expect that interest rates might lower? When would you predict that the Fed, in any of its series of meetings, or is it even going to happen this year? And then I'm going to make this a two-part, because is a quarter point drop even going to make a difference for anybody?
Well, those are all very good points to raise. Seems to me that is the risk that markets are worried about. And we were seeing, of course, the stock market got hit, bond yields up after those numbers. That's not a surprise, right? I mean, people were kind of probably positioned for something like just a moderate number, hoping for something weaker, and now you get something a lot stronger. And I think it seems to me the risk for the Fed is that they won't be able to cut rates this year. If the economy is staying this strong, unless inflation starts easing a lot more, it's going to be very tough. People are betting more and more on a September rate cut. Maybe they don't cut until right after the election. And that was a scenario that Dennis Lockhart, who's a former president of the Atlanta Fed, posed to me a couple of months ago, but I think it's valid that the Fed may have to hold off, but they would have two meetings at the end of the year. It's interesting because the November FOMC meeting comes right almost a day after the election, and then there's a December meeting. So they would have that door to go through. But I guess that's kind of like being, I don't know what I was going to say, not exactly purgatory, but limbo. That's the word I'm looking for. You can't quite cut rates, but you don't really want to have to raise rates. And this idea of higher for longer seems to me, if I'm looking at this as a Fed official, or someone thinking about mortgage rates, et cetera, how it could affect their lives, seems to me that's the potential, unless we suddenly see more signs that the economy is a lot weaker. For them to cut at this point is just it seems to me it would send a very funny signal. I don't see that. But as Tom Honig told me recently, who's former president of the Kansas City Fed, they're in a fragile equilibrium. They can't raise rates right now. It could shock the markets, and there's concerns about financial stability, all kinds of things like that. And at the same time, they've just kind of got to wait and see if this hope and forecast that prices will keep easing a bit comes true. But I think I'm betting that wait, let's talk about the dots. What are the dots going to do? I think that's a big question next week, don't you?
Expand on that.
Well, we've got, every quarter, the Federal Reserve issues a summary of economic projections.
Yeah.
So everybody comes to the table with, here's what GDP is going to do on employment and inflation. And what interest rate, what Fed funds rate, what key rate would be consistent with that. And so they have an interest rate forecast. Now, in December, the median was for 3 cuts this year at least. Then in March, it pulled back a little bit. So that's very important too. What are they going to signal? Has their view, we see that this median dot or all these individual dots show fewer rate cuts? Will they say maybe 2? I mean, that's going to be a big question. I think that is potentially the big market mover next week.
Yeah, for our viewers, they don't give us this summary of economic projections every meeting. We are getting one next week at the meeting, and this is going to go over what they anticipate that the unemployment rate is going to be by the end of the year, those rate cuts, so basically what their Fed funds rate is going to be. And those are very interesting. I think they had anticipated the unemployment rate, climbing up as they continued this rate hike campaign. I'm glad that you talked to former Fed President Thomas Honig, because we also, he and I talked about this, what he called an unstable equilibrium real rate. And I'm wondering if this keeps going, if the labor market keeps pumping out pretty strong numbers, and this number this month is higher than the 12-month average. So we are looking at a lot of jobs added here in perspective to the last year. Could we see a rate hike?
Wow, that is a tough one. Seems we could. Look, what if we get more strong job reports? I think the Fed's going to be willing to wait and not hike rates, though, as long as inflation stays where it is, doesn't move higher. They, and if it falls a bit more, hey, and there's a lot of people who expect it will, are still looking for that, including people at the Fed. But for now, a hike would be a much tougher call. And again, you talked to Tom Honig recently, and of course, Tom was not only president of the Federal Reserve Bank of Kansas City, he was the vice chair of the FDIC, the Federal Deposit Insurance Corporation. Let me get a little bit nerdy here, but I think this is very important because I don't think it's gotten enough attention. And that would be that in the minutes of the last meeting, okay, it showed a big paragraph where various Fed participants, how many is that? Well, it's more than one or two, are concerned about financial stability. They're concerned about risks in the banking system. There's still a lot of unrealized losses in all kinds of books. As Tom pointed out, there's various kinds of loans, the more and more in distress. It's something that is also in the background. But to him, that's one of the main reasons the Fed won't be able to hike rates. They're going to sit tight and hope that things move in their direction. And at the very least, inflation doesn't move higher and that it maybe starts moving a little bit lower.
And what's behind this instability in the banking sector? He did talk to me about that as well. Is it just the commercial real estate that's going on with those troubled loans? Is it, we know that even from a personal aspect, there's higher delinquencies on personal loans. So what's going on with the banking sector right now? And why, and how does that affect the rest of it? I mean, if the banking sector stumbles, we can anticipate that our data points aren't going to look so pretty anymore.
Well, as long as that's all true, and it's an issue in the sense that I was out at Stanford Hoover Institution when John Taylor of the Taylor Rule was holding his annual monetary policy conference. And I spoke to a couple of people, Ross Levine included, who's at Stanford, was at Berkeley for many years. And some work they've done suggests that potentially there are many banks, they estimate, Ross Levine and others, that it's maybe a little more than half, and not so much the big banks, but that they are unrealized losses. And as long as you don't have to, as long as the market doesn't move against you further, as long as they can just sit on them and let those things roll off, they'll be okay. But I think that's the question. Is there, if we get another shock, if there's something that, and again, that's getting back to the Fed raising rates, raise rates at a time when some banks have books that are not exactly solid. There's those hold maturity loans were such an issue during in March of 2023 when SVB went under. This is something that is under the surface. I don't think the Fed looks at it as an issue right now. I think they just view it as something they have to watch. And again, that's why I think Tom Honig talks about this fragile equilibrium. So I think I don't know if they pray at the Fed, if they pray to the monetary policy gods, but I think that's another reason why they're hoping that that won't happen. We just saw Christine Lagarde, ECB, cut their key rate with their inflation rate has come down a lot, but forecast to go up a bit this year. So they are more in that camp of let's take the step first and see what inflation does. Fed's certainly not going to do that.
Before I let you go, Kathleen, you have a lot of these one-on-one conversations, so I want to see if you've gained any insight into how these Fed members are feeling about the election year. Do they feel that it's, obviously a very difficult time to be making any type of big monetary decision? Do you think that they would be acting differently if we didn't have a presidential election right around the corner? That's
a great question, actually. I take the Fed at face value that if they have to do something, they will. Now, would they want to say hike rates in September? Probably not. At the same time, if the data, if the numbers are saying, hey, you got to do something, if markets are getting uneasy because inflation starts rising again and they don't do something, of course they're going to do something. I believe that. I believe in the Fed in that regard. At the same time, it does probably make it harder for them to have to do something like that. And again, I guess the positive side of the coin for the White House anyway would be, gee, the Fed hiked rates, but it's because the economy is so strong. I don't think it's the biggest factor hanging over their head, but I do think it's probably something that it's there. It's just, I really do believe it's not going to stop them from doing something they have to do, but it's going to make it tougher to do something they have to do potentially.
And then let's just bring it back to where we first started on this Friday morning, which is this May jobs report. With 272,000 jobs added in May, the unemployment rate ticking up a little bit to 4%. What are your big takeaways on how this report shaked out?
Well, it's interesting that this is something that, I mean, I didn't think it'd be weaker myself, and I don't torture numbers like a lot of economists I know, but it reminds me that we went through a period, what, a year or so ago, when every employment payrolls report, was stronger than people were expecting. Mm-hmm. But this is when you look at payrolls, when you look at wages, it's clear that it was stronger than expected, right? And then when you look at as I told you, the establishment survey, they really do. They call up about 500,000 people and ask them, are you looking for a job? All kinds of things. And that was the one where it showed that the household survey, that the jobs picture looks weaker there. And so you get this small increase in the unemployment rate. And I think people are already, I'm looking at some stories here, are looking at surging immigration. That may have been picked up with more people coming into the labor market when you call them at home. You see that, but you don't see it you see that in the payroll survey, talking to companies, but not in the household survey. At any rate, I think it's just, this is stronger than expected. This puts, if the Fed was going to be on hold for a while, if rates are going to be higher for longer, this is going to underscore that. That's going to deepen that. And we, again, all the more importance on the CPI report next week, because that's going to show us where inflation stands. But again, those numbers aren't necessarily going to change that much. You have to look at services, for example. That's where inflation's been a lot stickier. Right. Do you work in an airline? Do you, work in a hotel? Are you a lawyer versus are you in terms of goods prices, what's going there? And so again, I mentioned jobs because that's what drives service prices. Anyway, bottom line, what I get from Fed people I've talked to is they know they have to wait. They have to wait. I don't think anyone's looking for a rate hike at this point unless something looks a lot stronger and inflation starts rising. And if it doesn't, just sit back and wait.
I wonder if they regret some of the sentiment from last year, which was perhaps too optimistic in thinking how much they'd be able to cut rates this year.
Well, the numbers did come down a lot. They came down a lot because goods prices fell, supply chains opened up. But services prices have never come down as much as goods prices. They're still much higher than they were before the pandemic, et cetera. So, I mean, maybe they did kind of jump the gun, but the numbers look so good. And when you talk to Austin Goolsbee, who's been very dovish, she's president of the Chicago Fed. Austin, I think, was a little bit later to say, yeah, we've got to sit back and wait, but he sitting back and waiting too now. I think if we look at sort of a centrist, we're looking at Raphael Bostic, who's president of the Atlanta Fed. I've always considered him someone who's kind of in the middle. I mean, he doesn't go necessarily dovish or hawkish. He recently said that he couldn't see a rate cut until the fourth quarter. When you see numbers like this, when we get past this meeting on Wednesday, the Fed will start talking, I think, by Friday. Be interesting to see if we get any kind of comments about, maybe no rate cuts at all. But again, the dots, that gets us back to what do we see in their forecast for cuts this year, holding whatever. But I think many people were surprised that when you get to January, February, March, all of a sudden you see, prices aren't coming down so much. But Jay Powell had said at the March press conference in particular, I think, look, we have to watch goods prices that are coming down. That's where most of the improvement has been in inflation. Now we have to see services prices coming down and shelter prices, which is rent and your mortgage, et cetera. So is that, that's the worst that could happen. Maybe that's not so bad.
Yeah. Okay. Editor-in-chief at Central Bank Central, Kathleen Hays, it has been so fun to have you on this morning. Thank you so much for walking me through all of this and giving our viewers the jobs report on this Friday morning.
Well, it was fun. I love doing this. Like I say, it just, we're nerdy, right? You get these little goosebumpy feelings about jobs report, Jobs Friday, right? So come on, join us, everybody. Get nerdy. It's really quite entertaining.
We have a lot of fun, we promise. Okay. Thank you, Kathleen. I appreciate it.